A stop loss. Very, very, very important. All professional traders never enter a trade without simultaneously placing a stop loss. Amateur traders often forget to place stop losses, or they may even place stop losses as afterthoughts. You're going to know exactly where your stop loss goes long before you even consider placing the trade. You're going to know where your profit target is going to be long before you consider placing the trade. And you're going to know where your entry point is long before considering placing the trade. And from all of those elements and 1% of risk, in this session we're going to figure out how to generate the amount we place on the trades. We must know all of these elements up front, where we get out if it goes wrong, where we take our profit objective, and knowing all of these elements will combine mathematically to find out how much we should place on the trade based on risk. Well, our initial stop loss is really telling us where we should put that stop loss, that order to get out of the trade if it immediately goes against us. And the golden rule for this really is we must ask the question, at what price level will my reason for entering this trade become invalidated? And it's at that price level where we should place our stop loss. It's very much as simple as that. Now, you could use things like prior swing lows outside of the current trends, just below support levels, or on short trades just above resistance levels, but we must have something which protects that initial stop loss. Again, if we throw a dart at a chart and enter a trade based off excitement and just throw our stop loss just behind where we buy, the likelihood of getting stopped out is tremendously high, and we certainly don't want to do that. It's bringing too much risk into the game. Okay, let's dive into this example here. Let's have a look at the initial stop loss placement on a breakout. We can see the price level here of about 590. In fact, 595. We decide to buy Dana Petroleum, DNX, because it's broken through the major resistance at 595. Our stop loss must be set close to this breakout area. It could therefore, or will therefore, prevent us from an immediate whiplash retracement. What I mean by a whiplash retracement is one where it moves up and then suddenly moves straight against us. So in this particular example, we're going to sit and put our stop loss just underneath here, just underneath resistance as it breaks through, remembering that on a breakout of resistance, resistance immediately becomes... That's right, support. So immediately we can place our stop loss just underneath that support, and we would hope that that new support level will provide some protection for us. For a stop loss on trend lines, let's say in this particular example here, if we dive into that, we're looking at buying Longmin at 1150 because it's currently at the bottom of this upward trend. If Longmin breaks down through the trend, let's say trading at around the 1139 level, if I zoom in on that on this particular chart, that would be trading... that would be trading down at this level here, we'd certainly want to exit that trade. So we basically look at each trade on a case-by-case basis. It's either breaking out from resistance, a pivotal-based trade, or a trade based off a trend line, which particularly this example would be. Now, that initial stop loss, most people say, well, I couldn't have a stop loss that close. That's really often incorrect. Can't have stop losses that close as long as we really understand the technical levels around where we're placing those stop losses. Indeed, we must understand the basic price principles that we've learned in earlier modules, things like resistance becoming support when resistance levels are broken, where we place stop losses underneath trend line, and of course the holy grail, the pivots. We know where we place our stop loss based on pivots, and we're really going to start looking at some examples of those as we now dive through this practical. The trailing stop loss, really when we've decided that we're into the trade and the trade starts to move in our direction, we then start to lock in profits as we basically look to move that stop loss up higher and higher and look to gather as much ground as we possibly can. So let's have a look at that in this particular example. Let's say we decide to enter the trade here at 571. Let me annotate this as I go along. So we're entering the trade at 571 through this line here. It starts to move up, and as it swings low here and continues going, this first prior swing low here, we're trailing our stop loss to 611. So if it does then come back to this level, we do capture some ground. Then the stock moves up again, and this time it swings again before moving up. So now we would trail our stop loss to this 639 level. And then you notice we have an ugly spike day here where it spikes down and takes our trade out. And obviously we'll close the position at that particular point as that bar crosses the dotted line. If I just zoom in on that bar there, you can see here's our stop loss trailed up, and then as this bar comes down and spikes, we can certainly see that we would have been stopped out here, but we've certainly managed to lock in enough of that profit up all the way up there to that 639, just under that 640 level. Notice we've placed our stop loss again just underneath that big figure. We know that big figures do get tested, so it's likely that our stop loss will sit underneath the big figure there. Okay.